Hi there fellow investors, is Alibaba stock is screaming buy or should we pass on this one? This stock is up about 80% year to date, and today I'm cutting through the noise to reveal the real cost of buying Alibaba and what my deep dive analysis actually uncovered. After having crunched the numbers, my verdict is clear. The opportunity cost of buying Alibaba stock at the moment are just too high, and to prove this to you, I'm going to give you an industry comparison. I'm going to deep dive into the financials, and at the end of the video I'm going to give you my intrinsic value calculation. But under certain conditions, this verdict of mine might change, and these conditions I'm going to explain in today's video. Thank you for tuning in, and let's dive right in. From the industry comparison, we will now see that Alibaba is mostly in the midfield, so it's not the greatest opportunity, but also not the worst. But this is why it's not a bad stock, it's just the opportunity cost is too high. For example, EPS CAGR 5 years, you can see is very low compared to others. Meili is actually right up there, the others are more or less similar. You can check out my video on Mercado Libre that I did to get more input there. The FCF yield, free cash flow yield, you can see also not high up Alibaba right here compared to others, but also not on the bad end. Debt to equity, they are okay, that's good. They have solid financials to that extent. PE ratio also in the midfield. PEG ratio, it's kind of bad, but this is only because I think their growth is not very strong in the next year, or is not expected to be strong in the next year, so I wouldn't get scared of by this. Price to sales ratio also you can see in the midfield. So valuation, from what we can see so far, is also in the midfield, not too high, not too low. Return on invested capital, you can see pretty much average. PDD crushing the numbers right here. Net profit margin also in the midfield. The same picture also for the free cash flow margin, 5-year average. As you can see, and gross profit margin, the same picture. Looking at the financials, we can see we don't have stellar growth rates right here. However, the growth rate for the revenue has been increasing from 5 to 9%, or is expected to go up to 9%. Earnings per share, you can see, have been increasing, and they announced right here a huge investment into AI and cloud infrastructure, so we have to see whether this pays off, but analysts are expecting that it will pay off. This is why they have a lot of growth right here. Free cash flow is not very spectacular, is actually expected to come down, which is kind of reflected in my calculations today, and we will see this in more detail in the intrinsic value calculation. Debt to equity is healthy, has been increasing slightly, but nothing to worry about right here. PE ratio for trailing 12 months below the 5-year mean, but more interesting today here is the PE ratio for the next 12 months, which has come up really, is now above the 5-year mean. And as we can see right here on the chart, the price has gone through the roof year to date. So this would imply it's not the cheapest stock out there. And this confirms this picture right here. Return on invested capital was not the highest in the industry, but shows a growth trend. So this is nice to see. If this keeps going, then the stock might be headed for the right direction. Now, what would actually need to change to convince me otherwise that this is actually a good stock to buy now? Well, there are two possibilities, basically. The first one is, of course, that the price comes down to a cheap level to buy in. And the second thing is that we see the AI and cloud infrastructure investments actually paying off so that earnings will grow significantly. But right now we don't know this yet. And this is a gamble at the moment. This is an uncertainty. And I think it's priced in that these AI investments are going to pay off, and so we can only lose right here if they don't pay off. So basically what I would want to see is the price coming down to a more reasonable level or to a cheaper level in order to change my mind here. You can see, including a margin of safety of 30%, I get a value of $178. Current price sits at $153, leaving us with an upside of 16%. However, I always give you the range, which is a huge range, you have to say, but this is because the valuation swings of this stock are very high. For example, I can show you this chart. This is the price to free cash flow ratio, and it has been more or less stable over the years, but now like between 10 and 30. but now it jumped to over 100 right here. And there we can see if this is a 3x or 4x just on a valuation jump, that makes it difficult for me. So this range is huge and this gives me an uncertainty, right? So in the worst case scenario, we have a downside of 66%. In the best case, an upside of 400%. If I assume a multiple of 100, as we can see where it is now, and a growth rate of 20% in the best case scenario. So I don't think 20% of growth is unrealistic, and apparently a multiple of 100 is also not unrealistic for the free cash flow, because this is where we are at right now. But of course, this is what I'm saying. This growth rate right here may also just only be 10%, and then the intrinsic value, as you can see in the best case scenario, comes down to 390. So I wouldn't rely too much on these best and worst case scenarios, because they are really the most unlikely to happen. But as we can see, the normal case scenario, $178 is more or less where we're at. So I think according to this calculation, the stock is more or less fairly priced. But we have some uncertainties right here, and an upside of 16%, of course, is not hugely positive. It's not the greatest opportunity that is out there. But all in all, Alibaba is a great company. It's a very large company. This is why they have to deliver more in order to show growth. They're not overvalued. They're not undervalued right now. I think they're more or less fairly priced, but I think they need to prove that they can do AI. They need to show that these AI infrastructure investments can pay off. And then I would be convinced that the stock has a certain upside. But after the price jump year to date, right now I would be more cautious. The downside is certainly there in the worst case scenario. But the most important thing here is that there are just better options at the moment out there that you could invest in. So the opportunity cost is huge in my eyes, which is why Alibaba is not a buy for me at the moment. If you own the stock, I think you can hold it, but for me right now, it's a pass. You can also check out my video on Mercado Libre, which is in the same industry, just in Latin America. And this is a very interesting stock at the moment. I think more interesting than Alibaba actually. Please let me also know in the comments what you think about Alibaba stock, whether you hold it or not, whether you think, for example, Mercado Libre would be a better buy. Thank you for tuning in today, and I'll see you in the next one.